All right, here we go. Hold your ears, folks. It's showtime.
Live from the basement of the YouTube headquarters, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug. On today's roundtable, we're talking about piggy banks and other outdated financial ideas with a guy who's been around long enough to have witnessed them all, OG. Also joining us today is the man who's got the prescription for where to invest next. From Earn and Invest, it's Doc G. And finally, the member of the Stacking Benjamins family who just might be young enough to still have a piggy bank from Afford Anything, it's Paula Pant. Oh, geez, so salty about that intro. But that's not all. Halfway through the show, I'll share my youthful trivia question. And now a guy who many have mistaken for Father Time, it's Joe Saul-Sehy.
Did I prove that open?
I got everybody in that one.
Oh, my goodness. Hey, everybody. Welcome to Time to Fire the Writer podcast. I'm Joe Saul-Sehy, Average Joe Money on Twitter, and we're going to have some fun today. We're talking about outdated concepts in financial planning, and a guy who is definitely not outdated, but he is still out on assignment in the room he's in. 1972 wants their paneling back. It's OG. How are you, man?
Oh, just living the dream one day at a time, man. Just, happy to be here. I'm here so I don't get fined.
You are out on assignment, which is why you've got the wonderful audio going today, too. Good work.
Hey, you're going to be shocked. This audio might be magnifique.
Speaking of magnifique, there's it, Money Feet. Doc G is here from Earn and Invest. I don't know. You've been called Mr. Money Feet before?
Speaking of feet pics.
Actually,
it's Doc G.
I was once told I had really nice feet. I won't say by whom or when, but that was once a compliment I got. So I'll take it. Money Feet can be my new nickname.
Is that an awkward moment, or were you happy for that one? Yeah, because Doug's giving a look right now that's kind of the way I feel. Like if somebody came up to me and go, "Oh, Joe, you got really nice feet."
I was in my dorm room and I happened not to have any socks or shoes on. And I answered the door and someone, came in and I was talking there. Like, oh, by the way, you have really nice feet.
Those hairy toes really do it.
It was awkward. Yeah.
This was a plot from a Cinemax movie in the 90s.
Well, Josh, OG, I didn't have to worry about it because I had just recently plucked the hair. So it was good.
You're like, I don't have any way to pay for my pizza, sir.
Right.
But I have my feet.
This story's supposed to start with, I can't believe this happened to me. Right. And she can't believe it's happening to her right now because she's back in Stacking Benjamin's, wondering what the hell she's doing here from Afford Anything. Paula Pant.
Oh man, I there's a 6 feet under pun here that I'm grasping at.
Multiple feet. Yeah. No, it's good. It's great. You know what's even better though, Paula?
What's that?
The fact that this episode's brought to you by State Farm. Doesn't that make it better?
Much better.
It's like a good neighbor. State Farm is there. Talk to your local agent today. Thanks to State Farm for sponsoring all of our Friday shows. And we've got a couple more sponsors that keep this free so you don't have to pay for all these feet of goodness. Feats of podcasting strength. I don't know how to get feet in there, but I will get the sponsor spot in here. So we'll be right back. All right. Paula Pants here. OG's here. Doc G and Doug. We're talking outdated concepts in finance. Let's go. The inspiration for this piece came from something I found on Apex Money, which is a great website. Jim Wang curates a lot of great pieces. And we're not going to go to the piece that he was referencing. It's from Contessa Capital Advisors. I just saw the headline, and the headline was called "No More Piggy Banks," and it gets into kids in finance. But I thought, piggy banks, if you're trying to teach kids about money right now and they have a piggy bank, like kids aren't gonna be handling a lot of money. They need to know how the debit card works, right? I mean, what's that joke where parents, kids saying to mom or dad says we don't have any money, they're like, well, hey, why don't you just put that plastic thing back in that machine and grab some more? Or just take out the plastic. I mean, that's what you do. We don't even go to the machine anymore. How about ATM might be becoming outdated? So I wanted to have a discussion here on Friday about what are some of these outdated concepts in personal finance. So Paula, let's start with you. The piggy bank's already done.
Yep.
What's another outdated personal finance idea we can chat about?
Along with piggy banks, the proverbial stuffing money under the mattress. Right. But I'll put those two in the same category. The one that I want to introduce, this is going to be a controversial one. Oh, retirement age. Ooh, dun, dun, dun. Specifically a one size fits all retirement age. Of course, there's a certain age at which you can derive Social Security benefits, etc. Right. There are those there are those ages that like the cultural zeitgeist kind of views as quote unquote retirement age because of the way that Social Security is constructed. But I would argue that the overall notion of a one size fits all retirement age is outdated.
60, 62, 65, like that first thing that comes to your brain.
Exactly. I would say that's outdated in both directions. So there are some people who want to retire when they're 40, and there are other people who are like Betty White, was working until she was 99 and a half years old.
But OG, this is a firmly entrenched one, man. I mean, I'm somewhere less than age 60, but I do see friends right now talking about, no, I'm a long way away from it, pal. Long way away from it. I'm seeing friends and people, starting to talk about, like there's this cultural expectation, OG, that this 60, 62, 65 is happening. And even if somebody wants to work, right? I know a guy that just started a new career and he is 64, 65. And I'll tell you, some of my other friends are going, what's he doing? He should be enjoying himself. Why is he going to work in a new job at age 65? Like, this is crazy. So do you think it's outdated, OG?
Well, the funny thing is your friend is probably is enjoying himself. That's the whole idea of what he's doing. My grandfather worked air quotes until he was 92. He was an entrepreneur and had his business and had a big sign on the door that said chairman of the board. And most of the time you'd see grandpa would be inside his office sleeping, but he was still going to work every day and his name was on the door. So I agree with Paula on this. And I do think it's really weird that for whatever reason, if you try to do it early, people are like, what's wrong with you? And if you try to do it late, people are like, what's wrong with you? Like I was reading this Reddit thread on financial independence, and this person was like, I've been financially independent since I was, 35, made a bunch of money in investment banking. And he's like, I have to lie to my family that I can't, it's like, oh no, I got to work. It's like, I have to make stuff up for why I'm going to London or Paris, or I'm living my life doing my thing. And I can't say I'm retired because people are like, well, that phase will pass. It's like, no, the phase did pass. I'm into the new phase now. So I like this one, Paul. Good job. Bonus points.
Yeah, I think people also confuse this idea of employment versus work. And so when you're talking about retirement, a lot of times what we're really talking about is we don't want to be employed anymore because we want to have some control over our lives. But most of us are going to perform some kind of work. You might call it a hobby. You might call it a side hustle. And nowadays with our online world, it's easier than ever to make money at things. So all of a sudden you're doing something that doesn't feel like employment to you. You're not counting on it, but you're doing some kind of work and it happens to create some money. And so this line of what retirement is versus isn't, I think is really getting blurred.
It's funny, Paula. I think it is controversial, but apparently not among our panel. Like, we're all on board with this.
The enlightened crowd.
That is us. That's right. Doc, let's go to you next. What's another outdated construct in finance?
So because Paula brought her game up, I feel like now I have to bring my game up too. You
have to redo the whole list. I know, I feel the same way.
I know, my whole list is like I've had to check things out. I think another really controversial one that goes back and forth is that money will make us happy. And so we all know there have been all sorts of studies. Originally, they said that up to something like $70,000 a year, now this is dated, but up to $70,000 a year, you make that much, that caps it out. And once you make more than that, you're not happy anymore. And then they re-looked at the studies, Kahneman and Killingsworth. They went back and re-looked at the studies and they said, no. For some people, making more money makes them happy. But I think a lot of us are getting to this point where we're starting to look at this and realize that generally the connection between money and happiness is not as durable as we think, and that the connection is more about human relationships that makes us happy, and maybe money is a really good tool. And so I think that's one of those kind of outdated pieces of information out there that still people are banding about, this idea of, get good with money and it's going to fix things. And I just don't think it really relates anymore.
Yeah, but OG, if we've got somebody listening to us right now and they're making $28,000 a year, they're like, I bet money could fix some things for me.
I think that there's some truth to this, but when it comes to behavior, if you're not good with managing, 28,000, you're not going to be good with managing 280,000. That's not going to solve a behavior issue. It's not going to solve a systems issue. It's going to magnify problems if they exist, right? If you're a degenerate gambler on iPhone apps, for example, and now
let's take that as an example.
For instance, and you all of a sudden have some extra money, you're just going to do it with an extra zero on the end. What was $100, casino trip is $1,000 casino trip. It's like that's going to happen, and magnify those things. So you have to work really hard as you're moving through the different stages to develop good habits, even if those habits are seemingly inconsequential. Like, yeah, I know they say pay yourself first, but look, I'm making 28,000. I could pay myself first a whole $3.50. It's like, do it. Do the habit and set up the systems so that when the numbers get bigger, the systems are already in place.
Paula, are you done with this one?
Yeah, I think the most concise statement that I've heard about this topic is money may not lead to happiness, but lack of money can lead to unhappiness.
But there is, so there's something called the Easterlin paradox, right? And what that paradox says is that basically, if you take underserved areas where everyone is underserved and you introduce money across the board, like give them some relief, it makes people happier very briefly, and then they fall back to their baseline. Mm-hmm. What the suggestion seems to be is it's actually comparative wealth. So it's not having wealth or not having wealth. It's having more wealth than the people around you, which does in some ways suggest that money itself is not the issue. We know this. There's studies out there that show there are cultures where they have very little money, right? You have 5 people living in one room. But when you look at their general happiness, we find that some of these areas have higher happiness than they do in the US. So it's interesting. And I don't know the answer. But what I do know is that not having money by itself doesn't necessarily lead to unhappiness, but not having money compared to other people in your community definitely may lead to unhappiness.
With the advent of the internet and the interconnected global sphere that we all live in, I think that comparative is now no longer confined to neighborhoods or communities. Now it exists on a national scale, and then beyond that, even on a global scale.
I think it's why, Paula, to your point, why so many people are depressed now, because you look at Instagram or TikTok and you see people living their best life, living way above your means, and it makes us feel comparatively like we're less.
Right. Whereas if you go online and you see somebody with 1970s wood paneling,
hypothetically,
right? You're
ceiling
like,
tile.
Yeah, and ceiling tile, you're like, hey, actually, my home looks just like that. Cool. And then you don't feel quite as bad.
You'd hypothetically be like, my backdrop, which looks like a workspace in a WeWork place, like doesn't look, all that bad.
Hey, these are the finest Home Depot shelves with my Amazon file folders.
It's frugality at its finest, Paula. It's good. It's great. It's funny, when I was thinking of this topic, I thought we'd come up with things like piggy banks, or the topic we talked about on Wednesday, which is this idea that, my house is my retirement. My house is my retirement asset. You guys instead are going all heady on me. So let's see, OG, if
it's
you can
Paula's
break
fault. It's all Paula's fault.
No.
break the trend.
You should have stuck with piggy banks. I had a whole bunch of stuff on piggy banks that look like pigs, piggy banks that were square, that had letters on them, look like blocks. Those are gone. Kid accounts at the bank. I had all those things. I think for me, we talked about this on Wednesday, but this is kind of a hill that I'm willing to die on repeatedly and maybe do. But the idea that as time goes on, you have to become more conservative with your investing style. For some reason, this is, permeated through literature of your fixed income should be equivalent to the age you are, which in Joe's words, Joe's world would be like negative 100% or something. Like it's just so much bonds, you wouldn't have any equities at all. But the reality is that probably came from when people retired at 65 and were dead at 68. And with life expectancy being a little bit longer, and especially if you have had a little bit more a positive upbringing in terms of wealth, you've likely had the experience of better medical care and better longevity, and you're working more around that as opposed to the averages. So I think if you have saved money, the chances of you living longer than even the averages is higher, I think, statistically. And so if that's the case, why would you want to be more conservative, when you're at that, like Paula said, that normal retirement age of 60 or 65, knowing that you have a 30-year runway of life yet. And by the way, if you've accumulated any money and you're doing your financial plan and you say, hey, by the way, there's a good chance I'm going to have money at the end of this, right? Like I've accumulated enough that there's going to be some for the next generation. Why in the heck would you want to take your foot off the gas for that generation? Like you have 30 years of your runway and then the opportunity to catapult the next generation or two in terms of your giving, whether it's that or, a charity or something that's important to you. Why would you want to chop that off at the knees? So anyways, for me, it's being too conservative too early. How's that?
Being conservative as you get older. Paula, this kind of goes back to all those rules of thumb we see online, I think.
Yeah. And this is one of those things that in the span of the last decade, my understanding of it has certainly been refined, because when I was in my 20s and I was learning about personal finance, you'd hear your age minus 10 is the percentage that you want to put in bonds. You would hear all of these rules of thumb, and with a more sophisticated, more nuanced understanding, you're right. There's a distinction between age and timeline can outlive you. So what you're really investing for is timeline, which is independent of age.
I mean, I've heard the saying, and I can't remember where I heard this from, but accumulation is science and spending down is poetry. In other words, it's all full of emotions, right? And I think we get to this point. And, I learned this from going to the Bogleheads conference last year, where you've got all of these really science and investing minded people. And, they're 80-year-olds who are talking about just starting or getting right in the middle of their 30-year tips ladder. And it's like, dude, you've got millions and millions of dollars in the bank and you spend $50,000 a year. You don't need to worry about a 30-year tips ladder. You're going to be fine.
What is that all about, by the way? Because you see it all over. Is that just somebody who's too smart for their own good? And they're seeing the leaf, but not the root of the issue, Doc?
I think it's poetry. I think it's all about emotions. And, I think this whole argument that OG brings up is about the conservatism it's poetry. We do what makes us feel safe and comfortable, not necessarily what we know would grow, for instance, the most wealth or leave the most for the next generation.
And, going back to something that OG said earlier to the previous comment, it might also relate to habits. So when OG was talking about, look, the habits that you develop when you're earning $28,000 a year are the habits that you hold when you are making $280,000 a year. Those are also the habits that you hold when you are 80 years old with a net worth of $2.8 million. but those habits of accumulation and preservation have still stuck. And so now you can't, you find yourself unwilling to spend because you're so
you've been a saver for so long.
Yeah, exactly.
Paula, are you saying that if I wet my pants now, I'm going to be wetting my pants when I'm 80?
Exactly.
Okay. I was hoping I'd grow out of that.
I don't know how we got there. Yeah. How did we get there?
Abort. Saying what you do now, you'll do when you're 80.
Yeah, quick, OG, pivot.
Yeah, pivot. I had a conversation, kind of what you were talking about, Jordan, a couple of years ago with a guy. I had a workshop, and he came up and it was talking with me afterward. And he says, this all makes sense, but I don't think there's anything you can do for me. And I was like, all right, cool. Have a nice day. Thanks for coming. But his whole thing was, he said, I've got, $5 million. I feel really good about that. I have it invested in municipal bonds. So I don't pay any income taxes on. A feature of municipal bonds is there's no federal income taxes. And he lived in Texas, so there's no state income taxes. He said, and I make $250,000 a year of tax-free income. I'm set for life. And my argument was, I don't think that you're thinking long-term enough. You're thinking about your time horizon, like what Paula was saying. You're going, hey, I'm 75. I've got till 85 or 90 or 95, whatever. And I can, parse 250 grand a year of tax-free income, and that's great. But what would happen to that $5 million account if you invested it for the next 20 years? It was probably going to double 2.5 times, maybe 3, depending on where you happen to fall in the market cycle. And 5 million turns into 20 million or 40 million. And tell me the good that you can do when you leave an estate of 20 or 40. I'm not talking about like leaving it to your kids. I mean, that's like children's hospital stuff. You know what I mean? Like, that's the power of compounding. Charlie Munger talked about this a lot, and has been getting a lot of play on this over the last couple of months. Like getting to your first 100K is the hardest, because after that, it's like all just compounding, and it works really great. That's kind of taken a lot of root lately in the media. And that's true at any number, right? You worked really hard. You took 75 years to get to 50 million or 5 million, whatever the number is. Like, why would you want to stop now when by the time you're 82, you could have twice as much. And by the time you're 89, you'd have twice as much again. And by the time you're 96, you'd have twice as much again. Like, the good that can be done. And even if you're giving it all to your kids or grandkids, or you're building a children's hospital or digging wells or whatever is important to you, the impact that you can have is so profound. Yeah, it's just, don't let off the gas, people.
People are going to hear from John Hope Bryant here in a couple weeks, which I always get excited about. But Doc, you've already interviewed John Hope Bryant, and this is what he talks about. Exactly what OG's talking about is, yeah, it's fine that you might be okay, but you've got this whole community of people. You could be a lifesaver to so many in your community if you don't let off the gas.
Yeah, and just providing financial literacy. I mean, John Hope Bryant is so big on financial literacy, but it costs money, right? And that money may or may not come from the government. It may or may not come from legislation. But heck, if you are in that position and you want to start funding financial education for these poorer neighborhoods, you can change the trajectory of a whole town.
Absolutely. But I'm thinking, even just for your family or for your street or for, whatever. Yeah. I mean, a powerful thing. I feel the same way, OG, when somebody is like, I'm going to be okay. You're like, oh, how cute. That's great. And I know that sounds a little judgy, but there's just so much work that we can do. And I get really fired up about it.
What about the argument that your kids should do it for themselves? That's another big question, right? Say, oh, well, I could do all this and I could leave my kids 50 million per se, but maybe it would be better for them if they learned and made their own money.
Had some struggle. Well, sure. But there's a difference, I think, between being handed stuff and being taught the habit, right? Because we talk about the habit. John Hope Bryant's big thing, which we heard on your show recently, and we'll link to your great interview with him, Doc, is that, there's groups of people that just never even knew this was a habit. Like, this was a thing. Oh, if I did this starting at a young age, like, good things could happen to me. Like, didn't know, because everybody around them was out buying stuff and, making everybody else wealthy instead of themselves.
There's a Chinese proverb that wealth lasts for 3 generations. The first builds it, the second protects it, the third squanders it, and then the fourth starts the cycle over again.
Well, and you know what's funny? Have you seen the statistics about that?
No. Mm-mm.
It isn't just a proverb.
Ooh.
It's 100%.
It's 100%
wow.
true. Yeah.
It has worked time and time and time again.
I mean, look, there was a story about the Vanderbilts that, obviously one of the wealthiest families in the entire history of mankind, and, whatever, the 1920s. And then they all got together, I think it was in the late 70s, some giant 100 descendants or something like that. Not a single person in the room had a net worth greater than $1 million.
Wow.
Out of quite literally the wealthiest family that ever existed of all time at that time. And, you have to be super intentional about that, especially if you're going to work on trying to, force it to last beyond, your generation.
And what's amazing about that wealth too, of that particular family, OG, if anybody's ever been to Biltmore and how beautiful this huge estate is
they don't own
North Carolina. Well, sorry?
I said they don't own it. They used to.
Well, but what's funny is that was second generation money, OG. Yeah. That was not Cornelius. That was George. That was his son's money.
Let's build this big thing. Dad would love
this monster. That's how much money he had. And by the time his kids were done with it, it was over.
It was over. Yeah.
Like went from this monster thing to not nearly as much. Wow. You know what's funny? When I brought up this topic again, I was thinking like, what do you guys think about this one? I'm going to do something tactical before we go to the break. What about this idea that if the interest rate is 2% lower, that's when you refinance your house? Because I frankly think that's outdated. I think that is old advice. You don't got to wait. Paula, do you got to wait for 2% to do a refinance?
No. And I also think that the difference in interest rate is only one variable. There's also the question of, do you plan on holding this mortgage for 30 years?
Yeah.
Or do you plan on accelerating your pay down and paying it off as, with lightning speed as fast as possible? That's going to play into it. There's also the
plans change, your cash flow changes.
Yeah, exactly. What else would you be doing with the money? Do you have huge life plans? Are you planning on quitting your job and going to grad school? Like all of those things are going to change your cash flow and to change. So, making some type of a broad, like generic rule of thumb that relates to nothing more than interest rate is quite short-sighted.
Yeah, when OG brought up the rule of thumb about bonds and, age and your money, it made me think of all these other, and I got like 50 of these. So we'll get to some of those in the second half. But at the midway point of every Friday show, we have this epic trivia challenge between our 3 main contributors, which are OG, Paula, and the guy who usually plays for OG because he hasn't been here a lot lately, but now he's going to play for Mom because Mom doesn't do the steps. Mom doesn't want to be bothered. Doc G is going to play for Mom. And what's interesting is we had an epic week of trivia last year with our guest, Bill Yount. By the way, a great discussion about DoorDash and Instacart and are these things really killing your sense of community? I'd encourage people to go back and listen to that great discussion. But we had something else epic happen last week. Paula won.
I did.
Which was amazing. So we got this battle for second place now. Paula has 7, Mom has 8, OG still with a comfortable lead out at 11. So who's going to win this thing? We're about to find out. But first, Doug, we need a question. So what's on tap for this particular day, my friend?
Hey there, Stackers. I'm Joe's mom's neighbor, Doug. On this day in 1995, Grateful Dead frontman Jerry Garcia died of a heart attack. The death of the legendary 9.5-figure guitarist hasn't stopped the band from touring, now with John Mayer as Dead & Company. If you're at all familiar with their fiercely loyal fan base, you already know that many of them may be too stoned to have even noticed the change. In 1987, a couple of deadheads from Maine wrote to Ben & Jerry's Ice Cream to request the brand launch a flavor in the late guitarist's honor, and so Cherry Garcia was born. You see what they See what they did there? Jerry.
Clever.
Jerry. Yeah, it's subtle. I mean, you really got to pay. The perfect snack to cool down after an intense game of hacky sack. In 2015, Ben & Jerry's removed criminal inquiries from its job applications. More recently, the company has joined one of their suppliers, Grayston Bakery, in a program called Unlock Potential, which is committed to hiring people with prior criminal convictions. Great news, OG. Luckily, Stacking Benjamins has never asked potential employees about their criminal history. Otherwise, we'd have a different writer.
And by the way, she wrote that herself.
She wrote that about herself. It was like a cleansing moment for her. So today's trivia question is, how many new jobs has Ben & Jerry's supplier Grayston Bakery created under its open hiring practice? I'll be back right after I stock up on ice cream.
All right. How many? We're going to start with the man leading the way. OG, what do you think?
It's probably greater than 6. My initial thought was 6. Doug's laughing. Okay, give me a clue that number's not accurate. Okay, I like it.
That's big hope for the idea of our criminal justice system actually rehabilitating people.
We can only find 6 people.
But I'm going to stick with the theme of 6, and I'm going to say 6,666.
Oh, for God's sake.
0.66. Repeating, of course.
No.
6,666 new jobs Ben & Jerry's supplier Grayston Bakery created. What are you going to do with that, Doc, on behalf of Mom?
6. I have no idea. I will go a little bit higher, and I'm going to say 10,000.
10,000 new jobs. Paula, you just look like you got hit with a brick when he said that.
If I'm understanding the question correctly, these are jobs for working for Grayston Bakery. Is that correct?
Yeah.
I can't imagine that the bakery would be that large or would have that many employees. So, like, if I were to take a
average
guess,
bakery she goes into in Manhattan, there's like 4.
Maybe 6 is the answer. Maybe 6 is the number.
It's 6.
Guess 6, Paula. And if you get it right, I'm going to scream.
Because, I mean, if the question had simply been, how many employees does Grayston Bakery have, right? If that had been the question, I might have guessed, like, I don't know, 500. So
there you go. You've got your answer.
So clearly I'm taking the under, which means that my guess is 6,665.
So dumb.
And again,
what's the score in this? I missed that part. Do we have a score, a yearly score so far?
11-8-7.
Oh,
you've got a nice, comfortable lead.
Yeah, we're 2/3 of the way through the year. I'm feeling really comfy right now.
Oh, well, we'll see if you should, because we've got 6,666 for OG. We've got Doc G at 10,000. Mm-hmm. And we've got Paula Pant at 6,665. We'll see who's right in just a minute. We'll be right back. OG, you opened up this thing by saying 6,666 new jobs at Grayston Bakery. How you feeling?
It's a big bakery, man. I'm telling you, they make a lot of ice cream. So
they make a ton of ice cream.
There's a lot of ice cream. I think Paul is underestimating. A lot of chunks in
those ice cream.
Paul is underestimating the amount of ice cream that Ben & Jerry's makes. I'm feeling super confident. Well, it's either 6 or 6,600. I'm not. It's somewhere around there, but it has a 6 in it. I'm fairly confident that there's a 6.
Well, apparently, Doc, you think it's a big bakery because you went 10 grand.
Yeah, I mean, what you don't know is they're the biggest outsourcing and union-based project out there for bakers and bakers' assistants. So there's actually hundreds of thousands of people who are. No, I'm kidding. I'm making this all up, but I want you to see my subtitle here on YouTube.
That was pretty damn good.
That was really convincing.
My subtitle here on YouTube is Trivia Master. So these are the positive affirmations I'm giving myself for my crappy answer. So I'm glad I had Joe going.
I'm like, what?
Wait, what? How did you know that?
I'm like, did you
Google
Wikipedia this?
No, you had me going too. I was like, wow, do you have a side hustle as a consultant for?
That's amazing.
Doc sounds criminally legitimate whenever he talks. Talk about an evil superpower you have.
That is scary.
It's all BS. I've been BSing my way through this whole thing.
I was going to say, you could. and the great news, folks, is he's a medical doctor.
Right. I never
so
passed my boards.
Right. Now, Paula, you went 6,665, but what was your real thought?
I mean, again, if you were to ask me how big Greyston Bakery is, I mean, not knowing anything about this bakery other than the fact that they are the supplier to Ben & Jerry's, but clearly they're just one of many suppliers. So they probably supply like cookie dough that goes into the cookie dough ice cream, but they don't supply the dairy. And Ben & Jerry's might not be their only client, but it's probably their dominant client. Anyway, with all of that, I would guess that they're probably a mid-sized business, so maybe 500 employees in total. So if you imagine that people in this program are, I don't know, 5 to 10% of the total workforce, maybe even 15% of the total workforce, we're talking ballpark somewhere around 50 to 75 people.
So you're thinking OG's first guess of 6 was closer.
Yeah, exactly. Assuming that they have a total workforce of around 500 people.
Well, we'll see. Doug, who's taking this
Hit
one
us
home?
with the digits, Dougie Fresh.
Well, speaking of digits, hey there, stackers. I'm ice cream aficionado and guy with 10 whole fingers, most of which are on my hands, Joe's mom's neighbor, Doug. During the break, I wrote a long letter to Ben & Jerry to campaign for Stacking Benjamins to have our own ice cream flavor. We already have a selection of cool t-shirts, but you can't exactly sell those in the frozen food aisle. Today's trivia question is, how many new jobs has Ben & Jerry's supplier Greyston Bakery created under its open hiring business practice? Largely funded by Walmart, Unlock Potential works with many companies, including Delta Airlines and Virgin Hotels, to find the best applicants among people who may otherwise be headed down the wrong path in life. Lisa Curry. The answer? Well, Doc was over by a mere 8,650. OG was over by 5,316, and Paula was over by just a smidgen less at 5,315, because through its commitment to an open hiring process, the commercial bakery has created 1,350 new jobs, meaning Paula has won an unbelievable 2 weeks in a row.
How the hell?
What is happening?
Look at that. Look at that.
Everything's upside down.
The August surprise.
It is making a run for it. Wow. From last to first. Wouldn't that be wild?
Incredible.
Yeah. You've now tied mom with 8, and now the race at the end of summer is on. Congratulations, Paula.
Oh, thank you. Thank you. Takes about. Celebrates with Ben & Jerry's.
Still a ways off at what was the 75 people, maybe 100, 150.
Yeah. Still
big program.
Bigger
1,200,
than 6.
1,300 people. Yeah. Bigger than 6. Yeah. Big program. That's great. I wonder if this program, what's the program called, Doug?
Unlock Potential.
Unlock Potential. I wonder if it told our amazing writer, Lisa Curry, that she should go into comedy. Like if that was,
it's a new path for her.
Time for the second half of this discussion about outdated concepts in personal finance. Second half of the discussion brought to you by depositaccounts.com. OG, you know what happens when you go to depositaccounts.com?
I'm going to deposit those accounts, baby.
Yeah, you are, because you can compare more than 275,000 deposit rates from over 11,000 banks and credit unions. And you know what, OG? You can do that for free. For free. And all you do, you go to depositaccounts.com and you look right on the front page. Every week, we pause for a second here and tell you what's going on with interest rates. So if you've got the national average savings account right now, you're at 0.51%. We've now ticked up just a little bit above 0.5%.
Big money.
But if you're in the top 1%, which is hundreds of different banks, and you can find the names of them at depositaccounts.com, so you can find the one that's right for you, 4.95%.
10 times more.
Yeah, big bunches. Top 1% CDs, 5.45, checking account, 3.75, money markets, 4.58. You know, I found that. I just went to depositaccounts.com, looked right at the front page. Bam. Let's move to the second half of this discussion. We started with Paula last time, so we will go in reverse order this time. So let's go to Doc G.
Are you looking for another question?
Yes.
Yeah,
sorry.
I only have one also, so I'm relying on you guys to brainstorm for me to kick off something.
So this is outdated
I thought the
financial
short-term memory
advice.
loss, Doc, had gone away.
Prevagen for the win.
Financial advice.
Brought to you by Prevagen.
I think some outdated advice that people fall for over and over again that actually keeps them from being smart with their money is that investing is hard. I mean, I think we've been brought up to believe that investing is really complicated and difficult, and you need some type of advanced degree to understand it. And I think it's really kept a lot of people out of the market and out of understanding their investments. And I think it's just bad that people don't know what their money's invested in, bad that they want to rely on someone else to invest for them. It doesn't mean a financial advisor is bad. In fact, financial advisors are wonderful. But that doesn't relieve us of the responsibility of understanding what we're investing in and some of these investing principles.
Well, and OG, it's funny, just as Doc's talking, I'm thinking about, when I began my career, it was a lot harder to invest than it is now. It was a ton harder.
Well, I mean, if you look at the evolution of money and money advice and investing and that sort of stuff over long periods of time, do you remember, Joe, Don Connolly tapes, like cassette tape? Paula, that's a thing. You don't know what that is, but do you remember Don Connolly?
I do. Yes.
So he was a senior vice president at Putnam and would produce educational cassette tapes for financial planners. This was back in the 90s. It's really cool. But one of the things I learned from him was about the information transfer. And what I mean by that is, like, years ago, 100 years ago, you would want to purchase a security. You had no idea what the price was. You were like, oh, I just want to buy GM stock. And you'd go to your broker and give them a check for $100 and they would send that to, you know what I mean? Like, there's a whole big process, and then you would get your stock certificate. Well, as a courtesy to redeeming shareholders, notice the phrase there, as a courtesy to redeeming shareholders, the newspaper started publishing the most popular stocks, closing prices in the newspaper. And you think about the transition of information to how that moved over the years from as a courtesy to redeeming shareholders to, oh my God, what's NVIDIA at right now? And like the information, the ability to have all of that stuff at your disposal now is fantastic for, the average investor, but I think they use that as a crutch. Sometimes people use that as a crutch of, like, there's too much. I don't know what to do with this, and it doesn't have to be, like Doc was saying, it doesn't have to be that complicated. You can make it complicated for sure, but it doesn't have to be that way. And 50 years ago when Joe was doing this, they had chisels and stones and carrier pigeons and all sort of stuff to, get information back and forth. And there was a need, right? I mean, like, you think about it, there was a sales pitch that was, I have more information than you. I'm a broker. I can get information faster than you. I know, you know what I mean? Like, that was a part of the sales pitch. Well, now everybody has all the information at the same time. Technology has made that ubiquitous. So it's not about information.
Yeah, it always blows me away when I still see advisors who talk in that language. You need me because I've got the information.
Yeah, super smart. It's like, bro, settle down.
Everybody's got the information. It's not about the information. It's not behavior.
I feel like it's changed. Yeah, it's changed behavior, goal planning, time management, right? Like, I can do this, but I would rather take my time and invest it on the things that I'm good at. I can make $1,000 an hour in my corporate law job, or I can try to do my financial planning. No, I'll sell that for $350 an hour or whatever it is, type of thing. So it's, that the role of an advisor has changed, but to Doc's point, it's not complicated. People make it complicated. And I think people who sell the complication, that kind of, can I say it kind of pees me off? Kind of pees me off a little bit.
Yeah, no, feel free. You just did. Paula, I'm just going to assume that you agree and take this to I'm going to flip this upside down. Some of our money nerds have taken this idea that it doesn't need to be complicated and we can understand it to VTSAX and chill for life, right? Mm-hmm. I can buy one fund. I live my whole life with this one fund. I know a great guy named Paul Merriman knows you can beat the hell out of this strategy. Mm-hmm. Like in some ways, have we just taken this way too far?
I think Morgan Housel has a really good quote about this where he says that people often make the wrong decisions when they take their cues from someone who is playing a different game. And so if the game that you're playing is, I feel overwhelmed, I'm a beginner, I feel overwhelmed, I want to do something because I understand that something's better than nothing, and this sense of overwhelm is a source of friction and is causing procrastination and is therefore leading me to do nothing. All right, if that's the particular situation you're in and that's the game you're playing, then the simple path to wealth, VTSAX and chill, is the perfect solution. But what happens is then you have a cohort of people who take their cues from the simple path crowd, but what that cohort really needs is a more optimal path, right? So you've got people taking their cues from others who are playing a different game, or who are, to phrase it another way, who are driven by different motivations.
Yeah, in a different part of their life,
right? Yeah,
absolutely. Paula, almost forgot OG. OG, what's your next one?
I was hoping you were going to skip me because I was like, I don't really have a good one. I think there's a really obvious one that I want to skip, which is the 4% rule thing. I want to skip that. I think people using debt instruments.
I'll just set this over here. Don't pay any mind to it.
Yeah. In case, I'm teeing it up in case Paul is struggling like me. I doubt it. She's locked in always. She's like, no, I've got way better one than the stupid 4% rule, dude. You can have that all day long, bro. I think that people using, I don't see this as much right now because interest rates are higher, but a few, 12 months ago, 18 months ago, people using debt instruments as cash or emergency funds. I kind of struggle with that because I've lived through the implications of, or the ramifications of Discover calling me and going, hey man, we understand your credit limit's $15K and we totally get that you're at 14,999.99 and we totally appreciate your payment of $5,000. We just wanted to let you know that your new credit limit is $10,000. And we sometimes people look at those numbers as gospel, right? They look and go, well, I've got, a line of credit at the bank for my business, or I've got a line of credit for my house, and assume that that's never going to change. And the reality is that if you read the fine print, they can change that whenever the heck they feel like it. And quite often they change it at the most inopportune times for you. It's not like, hey, the economy is great. You haven't used any of your available credit, and now we're going to change your credit line. It's always like, oh crap. My lips are above water, and now there's going to be a little bit of a change, and that adds additional stress. So haven't heard a lot of that, but I know that's still kind of floating out there a little bit.
Yeah, but at first, Doc, I think that what OG's talking about, there's never been a time that was acceptable. But then I go, well, is it? Because like colloquially in just family discussions, commercials you see on TV, it sure seems like these credit cards are there for a reason, and the reason is get me out of a bind, which is, I think, what OG's talking about.
Yeah, I mean, there's a bravado around emergency funds, and everyone's trying to be counterintuitive and say, oh, I don't need an emergency fund, right? Everyone wants to say that, and it just doesn't hold true. I mean, you need to have a certain amount of money that's not invested. And this goes to those optimizers, because we want to say that we can have every single cent invested in making money for us. And it's unnecessary. And, the line of credit thing, I agree, can dry up at any moment. And that's why we have emergency funds. I mean, there's a point behind this. There's a reason.
Well, and the reality is on the emergency fund / cash component, kind of parlaying that into all stocks all the time, is that's what gives you the opportunity to be invested aggressively, or all stocks, is because you have the wherewithal, or because you have the back end of that to go, all of the needs that I might have from a cash standpoint, are here for the next couple of years, or at least the next 2. So I don't have to worry about withdrawing money from my portfolio in a down market. That's really the trade-off. And as long as you have that cash, that gives you the flexibility. If you don't want to have the cash, then you have to plan for that flexibility elsewhere.
Let's bring this home strong, Paula. They've been teeing you up. You're probably the best one of all here.
Oh, geez. Well, I wouldn't give myself that much credit. But mine is actually, it's also related to debt, but it's sort of the opposite. It's the notion all debt is bad.
Oh, yeah.
Right? That notion was quite prevalent back in the day. And I think it comes from a good place. Right? It comes from wanting to warn people not to get in over their heads. But if you approach life with the idea of all debt is bad, so never have any debt, never have any debt, never have any debt, maybe a mortgage at most, you then just fundamentally discourage people from going to college. I'm not saying you should take out excessive student loans, but there's a point at which for many people, I'd say, for many, if not most people, you've got to take out some reasonable amount in order to get the training that you need to, in order to have the career that you want that will serve you for the next 40 years. If all debt is bad, then often you don't take as many risks in business. And particularly if you're thinking about a particular business enterprise that has high levels of upfront capital expenditures, and you have valid reasons to believe that if you could just get started, you would have sufficient clientele, but you aren't willing to take out a reasonable amount of debt just to get this business going. I mean, the aversion to debt can really hold you back and make you play small.
It's funny, you kind of bring up another one that is I think outdated, which is colleges for everybody.
Right.
I mean, just as a subset, I mean, that's a whole different one that we'll set out there next to the 4% rule. Maybe not go into today, but Doc, let's go to the obvious one here. When Paul is talking about all debt is bad, you've got these big gurus. Let's go ahead and say the name, Dave Ramsey, right? Saying that all debt is bad. Is that it's got to be one of two things. It's got to be either number one, he truly 100% believes all debt is bad, or number two, he knows his audience and he knows that having that mindset is the perfect place to start when you're somebody that's had their ass kicked by debt 55 times. I kind of think it is the latter, but which do you think?
Yeah, I mean, it's all about nuance, right? So I think when you're dealing with a large swath of people who are doing poorly, erasing all nuance makes complete sense. Thankfully, I think a lot of us, fingers crossed, get past that point where we're doing so poorly that we can't deal with nuance. And then we get to the point where we possibly can. And, money is one form of equity, but there's time equity and sweat equity. And if you're too afraid to use debt and leverage, you're going to be using sweat and time equity. And those have costs too, right? Or you use your own equity. Let's say you're too afraid to use debt on your new investment apartment building. And so you use all cash. Well, you've then consumed that cash in the process of using it on this investment, but maybe you only want to consume 20% of the down payment and then keep the rest of it invested and then use some debt, use some leverage. And so I think we have to be really wary of this idea. When you make these decisions, it's always a trade-off. And just by saying, well, all debt is bad, realize we might be trading that off for moments or hours of our lives in which we have to put in the sweat equity because we don't have the money. And so it's a great balancing act. And that's why any rule that says always or never is difficult, because we're predominantly different people at different seasons in our lives who need different things at the moment. And because of that, nuance is necessary.
I love that point you bring up really from 7 Habits. Like whenever you make one decision, you got to think about the other end of the stick, what comes with it. And if you don't spend the money or if you don't take out the debt, you're going to put in time. You're going to have these things don't happen in a vacuum. It's just like these 401k. How about this one for outdated? I think those 401k risk tolerance charts are complete BS. Like, why do we start with risk tolerance? Why wouldn't we figure out how much risk we need to take and then figure out if we can, because if I decide that I don't want to take any risk with my investments, well, then I, as I've said many times, very safely get nowhere. Just drives me crazy. There's always the other end of the stick. I think that's a great place to leave this discussion. Fantastic. We'd love to hear yours. If you are in our Basement Facebook group, give us some. Give us some on our Facebook page, on our Instagram account, wherever you interface with us. Tell us some of the most outdated concepts that you can think. And this all started because I read the words piggy bank, and I thought, wow, that is outdated. I love my piggy bank, by the way. It's great. Mine is mine's a pretty funny little bank that I keep my quarters and nickels and dimes in. Let's talk about not quarters and nickels and dimes, but your $1 billion activities that all of you are doing. How about that, Doug? See, I did it again. Just amazing. Ninja. OG, what do you got going on this fine weekend in August? Well, you're not. You're away on assignment, so you're living the high life while we're sweating back here in the basement.
It's it is back to raining so hard you can't see across the street. So living the dream in the 800 square feet with 6 adults. It's fantastic. So happy to be here. Really excited that I get to do this. No, we're this is our last week, and then we're headed back to Texas, and everything kicks off next week. We've got football camp, school, like summer's over. We are back into fall. It's
the real world.
Back to the real world, back to life, and back to reality. I should TM. Back to life, back to reality. TM.
Yeah, I'd never heard anybody say that before. Doc, what's happening at the Earn and Invest podcast besides the amazing discussion that I mentioned earlier that you had with John Hope Bryant?
Well, we just dropped an episode with Ed Slott, and we're talking about diffusing the ticking retirement time bomb. Man, talking about IRAs, 401ks, 403bs, this stuff is complicated, but strangely enough, Ed Slott makes it fun. So if you never thought you'd have fun listening to a conversation about things like IRAs, take a listen to Earn and Invest and Ed Slott.
That's literally why people are here, Doc, is to have fun talking about this stuff.
But besides here.
Okay.
That's what I was going to say. Just like here, I feel like Ed is just entertaining himself. Like, I feel like we're just entertaining us. And that's at the Earn and Invest podcast, where finer podcasts like Afford Anything are distributed. Paula, what's going on at the Afford Anything show?
On the Afford Anything podcast, we've had some great guests this month. Brian Feroldi joined us to talk about getting paid with stock options. So it's a deep dive into stock-based compensation. So if you are one of the people who is I am not, but if you are one of the people who is offered stock-based compensation, it's a super deep dive into understanding that world. What does it mean? What are the different iterations of it? How do you make decisions accordingly, etc.? How do you understand that world?
And he's the dude who might know a little bit about that.
Exactly. He is the author of the book, Why Does the Stock Market Always Go Up? And his expertise is stock investing. He has something like 400,000 followers on Twitter.
Billion, million.
Yeah, he's quite well known on Twitter for his stock market wisdom.
And very, very straightforward, great advice. Talk about, information being a commodity. It is a commodity, but there still are people that know, and people that you're like, what the hell are you talking about? Yeah. Brian's one of the former.
Delivery
Absolutely.
matters, right? A lot of the stuff is in textbooks, but delivery matters.
Quite entertaining. And that's at the Afford Anything podcast, where finer podcasts like Earn and Invest are distributed. All right, that's going to do it for today. Thanks, everybody who hung out with us on YouTube. We always announce ahead of time in our Facebook group, The Basement, when we're going live, but it usually is on Wednesday afternoon. So if you're somewhere where you can grab YouTube, you can hang out with us too, like people did today. Doug, you got it from here, man. End the week for us. What should we have learned today?
Sure thing, Joe. Here's what's stacked up on our to-do list today. First, remember that time when Doc G said,
"While money might not make you happy, having less than your family and friends surely bites."
That was awesome.
And don't call me Shirley.
Second, as Paula's insightful mind pointed out, we're living in an interconnected global sphere of zeitgeist. I think that means that you can retire when you transpose the X and Y coordinates of the space-time continuum. Pretty sure that's what she said. But the big lesson? Never ask Joe's mom to prove she has all 10 of her toes. She'll think you're trying to put her on Wiki Feet, which is ridiculous, because I'm not even on there and I'm famous. Thanks to Doc G for joining us today. You'll find his show, Earn and Invest, wherever you're listening to us right now. We'll also include links in our show notes at stackingbenjamins.com. Thanks to Paula Pant for hanging out with us today. You'll find her fabulous podcast, Afford Anything, wherever you listen to finer podcasts. And last but not least, thanks also to OG for joining us today. Looking for good financial planning help? Head to stackingbenjamins.com/OG for his calendar. This show is the property of SB Podcasts, LLC, copyright 2024, and is created by Joe Saul-Sehy. You'll find out about our awesome team at stackingbenjamins.com, along with the show notes and how you can find us on YouTube and all the usual social media spots. Come say hello. Oh yeah, and before I go, not only should you not take advice from these nerds, don't take advice from people you don't know. This show is for entertainment purposes only. Before making any financial decisions, speak with a real financial advisor. I'm Joe's mom's neighbor, Doug, and we'll see you next time back here at the Stacking Benjamin Show.